I would say to them, look at where the financial markets are. Stocks are at all-time high, gold at an all-time high, M2 at an all-time high, home prices are at an all-time high, bonds are rallying. What problem do we need to fix? What you can fix with cutting interest rates doesn't need to be fixed. That would be my argument to the Fed.
Hey everyone, I am thrilled to bring to you this special in-person episode of the Julia La Roche Show, where we are joined with a fan favorite of the show. We have Jim Bianco, president of Bianco Research. This is our first time meeting in person.
Yeah, it is.
So wonderful to meet you.
It's wonderful to meet you too. I'm looking forward to the conversation.
Likewise, and we love having you on the show, and so we're thrilled to have you back as always. And Jim, we got to start where we always start. Big picture, macro view for you today. What do you make of where we are in the markets and the economy? What's on your radar now, and where do you see things headed?
All right. So the big picture, I think, is right now is probably with the economy. We're getting no data, so we're all guessing on what it is.
Yeah, there's no data.
Yeah.
On the 24th, we'll get some, right?
Right. There is some data, to be fair about it. There's plenty of data out there that's in the private sector that you could kind of piece together what's going on. And I think from the economic standpoint, the most interesting thing is to talk about what's happening in the jobs market or the labor market. It has slowed down a lot. It is showing signs that we were producing 158,000 jobs in the last 6 months per month last year. We have produced in the last 3 months through August, the last data point we got from the government, 29,000 jobs. Now, normally that would be viewed as a disaster. And the Fed is sort of thinking that way because they've cut interest rates and they're talking about cutting them again at the end of October. However, something's changed, and something's changed in a dramatic way in the economy in the last 6 months. And that is the population growth of the country.
Yep.
The fertility rate's down. So population does not come from organically having more kids. It comes from immigration. And we have no immigration in the country. We've closed the border. The data that we're getting, we used to see 250, 300,000 contacts contacts by Border Patrol at the border back in late 22, 23. We're down to 24,000 now. But of those 24,000, about 24,000 of them have contact with Border Patrol, and then they send them back. They don't even get in the country. So it's effectively zero. That has taken the population growth of the country from January above average to an 80-year low in the space of 4, 5, 6 months. Now, why does that matter? We're producing 29,000 jobs a month. How many should we be producing? And the answer is what Jay Powell said at his press conference last month, somewhere between 0 and 50,000, average being 25,000. Mm-hmm. The Dallas Federal Reserve put out a study about 2 weeks ago. They estimated it at 30,000. So if we're producing 29,000, that's enough,
right,
given the population growth of the country. So this is the biggest question among economists. What's the state of the labor market? And they'll say, well, it's went from 158,000 to 29,000, so it looks bad. Okay, I understand that. But how many jobs should we be creating? And if the answer is only 25 or 30,000 because we've got no population growth, maybe we're still in balance. Why is that important? Because if the Fed is cutting interest rates, saying we have to juice the economy to get more jobs, if we don't have people coming into the country and we don't have population growth because we're not having kids, we have to have it through immigration, then we're not going to get to 100,000 jobs a month unless we have massive wage inflation. And so that's really the biggest issue in the economy right now. Markets, they're all going up. Everything, what's not going up? I mean, even the bond market's rallying now. Crypto's rallying, gold, silver's rallying, the stock market's rallying, the bond market is rallying, foreign markets are rallying. The only thing that's not rallying is the dollar at this point. So they're engaged in, kind of a happy medium or nirvana. They're perceiving that the economy is doing okay, that inflation is a little bit low. I don't agree with that. And so we've got all the markets going higher.
Wow. Okay. So let's talk about the Fed and the employment side of the equation. So it sounds like 29,000, we're producing enough, yet a lot of folks don't necessarily recognize that or see that because they're looking at, as you point out, like the old way,
right,
or when you had to cut off the immigration spigot. So are they making a policy error by cutting then?
That is the risk. That, now as of the day we're recording the market, you would actually argue the markets think no, because the 10-year yield's slightly under 4%, and the stock market is after selling off a week ago, it's almost back to its all-time high. But the risk is out into the future that they could be. Because if they're cutting rates on the idea that we need to, and I'll use the term that Jay Powell used at his press conference, risk management cut. I thought they were data dependent. I don't know what risk management means. I don't know if he knows what it means, but it
sounded buzzy. Yeah.
Yeah. If I had to give you a cynical definition of risk management cut, it's to get the orange guy off my back. So I'm going to cut rates because he's been calling me too late forever, and so therefore I kind of get him off my back. Well, if that's the case, and they're probably talking themselves into, well, the employment numbers are down, and the argument that Powell has used is, yeah, it's gone from 158 to 29,000. But how do we know that it's not on its way to like minus 50,000 next year or something like that? Well, we don't. I mean, it could be the case. But you also said that you don't like to forecast, right? So the risk management cut, the risk is you're going to cut rates. You're going to try and stimulate the economy when it doesn't need it. And you create inflation. And then you could recreate a backlash in the financial markets because you created inflation. If you want an example of that, last year in September 24, the Fed cut 50 basis points, followed up in October and December with 2 more cuts of 100 basis points. And what happened? Long-term yields went up during that period. They went straight up because they were saying, we don't need this. You're just going to create inflation. And that's the risk you have, is a repeat of that again.
Okay, so right now the markets are okay with it. And
Right.
I think it's fine. How about on the inflation side of the equation? When you think about the Fed's mandate, what about, I haven't heard your latest on inflation.
I think inflation is an issue, and I think it's going to stay an issue. And I think that there's 2 things that I've argued that are going to cause inflation: tariffs and remote work. So tariffs, let's start with tariffs. That's been a difficult one for people to get their head around. Just to give you some idea of where we're at, the average tariff rate was 2.5% at the beginning of the year. It is estimated by the Yale Budget Lab right now to be about 17.5%, 18%. So it's gone up 6x. The average tariff collected is about 10%. Okay, what if the tariff rate is 17 and we're collecting 10? There's a lot of people that have been making the argument, well, that's because export countries like China or importers like Walmart are eating some of that higher price and not passing it along to the final customer. So that's why they're being shielded from it. That was true probably in April and May and June, right after Liberation Day, when Trump made the tariff announcement, because a lot of companies didn't know what to make of these tariffs. And they were more concerned about protecting their market share than they were about passing along the prices. Well, by June or July, that ended. And they're like, nope, this is the world we live in. We're not going to eat these prices forever. And they're starting to pass them along. So I suspect that 10% actual tariff rate that they're collecting, that's just the value of the tariffs divided by how much goods get imported, is about 10%, is going to keep going up. Tariffs are embedded in the price. That is more inflation. So the inflation rate, which let's use the core inflation rate of CPI, because that's what's coming out on Friday, is 3.1% through August. If Wall Street's estimates are right, it's going to stay at 3.1%. But I think it will continue to go higher, maybe to 3.5 or 4 by some point between now and next summer. And so it's going to keep going up. Now, the other part of it is remote work. Remote work has been a tectonic change in the way that we work. You are no longer encumbered by your job location-wise. You can get a job remotely anywhere you want. So before COVID, about 7% of the workforce was remote. Let me give a definition of that so everybody knows what we were talking about. You get paid to do your job not at a central location. So not in an office, not at a hospital, not at a school, not at a site. You get paid to do it anywhere, somewhere else. That's remote work. Every day of the week is work from home. So work from home is just a subset of remote work. So with 7% before COVID, it's 27% right now. About half the jobs in America cannot be done remotely. So a waitress can't be remote, a fireman can't be remote, a surgeon can't be remote, a policeman can't be remote. So that means about over half the jobs that could be done remotely are currently being done remotely. That gives labor, workers more power to make demands on management. Give me what I want or I quit and I don't have to move to get a new job. And you're seeing that with companies now like Amazon, Microsoft, who have been making these big pushes, everybody back in the office, and people are saying, I'm not going to go back, I'll quit. And there's like, okay, most everybody back in the office is kind of where they're at. And you've seen this with GM. You've even seen this with the federal government to some extent too. And so a lot of people are pushing back on it as a sign that labor has more power. And if labor has more power, they can also push on wages too. So wages will continue to go higher. Tariffs will continue to push inflation higher. And I think even though you will get some deceleration of inflation because of housing, rents going down, it will be more than absorbed by these other factors that will keep the inflation rate elevated at least for another year or so.
Gold keeps setting new all-time highs, but price appreciation isn't the only way to profit from owning gold. Monetary Metals is redefining the future of precious metals investing. Instead of paying to store gold, imagine getting paid to own it. With Monetary Metals, you can earn up to 4% on your gold, paid in physical gold. That's right, your ounces grow each month, not just your paper balance. A yield on gold, paid in gold, means you're stacking more ounces every single month. And you still benefit if gold's prices rise. You're earning more gold every month and enjoying potential price appreciation at the same time. Go to monetary-metals.com/Julia to learn more and see how you can start earning 4% on your gold, paid in gold. And do you think, going back to like the job side of the equation, do you think that you were saying earlier that you would get wage inflation if you tried to like move that number up?
Yeah, because
how does that work?
If usually there's two things that create jobs in this country, right? Or to create the potential supply of workers. That is, population growth. We define, let me say it this way. We define the workforce as anybody between the ages of 16 and 64. How many people are between 16 and 64? 212 million is the answer right now. And what we want to see is how many people are being added to that group every year. Used to be about 2 or 3 million. And so you'd have to say that the supply of labor, the number of workers, they're looking for an additional 2 million jobs every year just because of the natural growth of the population. Well, that's down to, by some estimates, 0, other estimates, a couple of 100,000. Now, not 2 million. So that's really been, the big change there. So if we're going to demand 100,000, 125,000 jobs a month that we want to try and create, which would be about 1.5 million or so a year, where are we going to get the people to fill these jobs? Well, there's 212 million people in the country that are in between 16 and 64. There's 160 million that have jobs. So there's 62 million in that cohort that don't have jobs. Why not? Well, it starts at 16. If they're students, they don't have jobs. They're housewives, they don't have jobs. If they're disabled, they don't have jobs. If they're in the military, they don't have jobs. If they're independently wealthy, they don't have jobs. So there's lots of reasons that they're not in the workforce. Well, if you need to get 100,000 jobs a month, you need to say, we got this pool of 62 million. We're not adding to it that much. We need to entice them to take these jobs. Raise wages, wage inflation. That's the way you would wind up doing it. And if you raise wage inflation, typically the overall inflation rate should follow the wage inflation rate. So in other words, if the average person is getting a 3% raise every year, prices should go up by hopefully a little bit less than 3%. So you make some real gains, but they're not going to go up 1 and you're going to get 3 because what will happen is everybody will get so wealthy, they'll start bidding on stuff. Man, I'm making more money and it's not costing me anything more to buy stuff, but I really want this stuff, so I'll bid on these vacations or I'll bid on these products that I want. In other words, I'll pay more for them. And that's how you get that, that demand pull on inflation higher. So this is why it's very important that a lot of the economic data really revolves around the population growth of the country. The other half of it is productivity. How more productive can we be with our current workforce? If we could be more productive, then I don't need as many workers. And then that existing pool of 62 million, they'll be let go because I can do it with less, and they can go find another job that the market is out there looking for. But productivity isn't the main driver of the supply of workers. It's population growth. And that has dramatically changed from March. In March, it was something completely different. That's about the time that Trump really got going with closing the border and increasing deportations to where we are right now.
Okay, so the FOMC is coming up end of the month. If you were in that room, in that presser with Jay Powell, Fed Chair Powell, what would you ask him?
Well, I would chain myself to the door and say, no one's raising rates and no one's going to be allowed out of the room until you all agree with me. But I will lose that argument.
Because ultimately that would be a policy mistake. Then.
Yes.
Okay.
I fear that it will be a policy mistake. I would argue against it. I don't think, I would say to him, look at where the financial markets are. Stocks are at all-time high, gold at an all-time high, M2 at an all-time high, home prices are at an all-time high, bonds are rallying. What problem do we need to fix? And he might say low employment. And I would say stocks are at an all-time high, M2 is at an all-time high. Housing.
Nobody's cutting rates. Don't cut rates.
Right. I was going to say, where are the financial markets worried about the low employment report? They're not. Remember that monetary policy, to quote a term that the Fed likes to use, works through the financial channel. They cut rates to stimulate financial markets to make us feel better and make more money to grow the economy. Why do we need to stimulate the financial markets? What problem are we trying to fix by cutting rates? Now, if you said to me the low labor market, I would say, you're right, it's low. There are other fixes. Maybe immigration, maybe not illegal immigration, but being more liberal on legal immigration, worker permits. That could be a way to get more labor supply into the market. But it isn't going to happen because you can't fix that with cutting interest rates. What you can fix with cutting interest rates doesn't need to be fixed. That would be my argument to the Fed. And I know that will fall on deaf ears and they will cut rates because they've pretty much signaled that that's exactly what they're going to do.
And the market's going to love it.
The market's going to love it. See, the thing about this is on social media, everybody comes back to, they're all momentum players. Well, what do you know? The market's at an all-time high. And I like to say it is until it isn't, because what you're saying is it's at an all-time high. So tomorrow it'll be an all-time high. But then tomorrow, since it's an all-time high, the next day it'll be an all-time high. So it will never, ever go down again. We can end the show right now, right? They're just going to go up every day forever. But that's a momentum argument. They obviously, the market goes up until it doesn't, until it realizes either it's made a mistake or the situation has changed. And what I would argue is these are the kinds of things that can change the situation if the Fed is erring. Now, maybe they're not. Maybe they're right that there is some serious weakness and they're cutting rates to try and address that weakness and it isn't apparent yet. But maybe they're not. And that's the real question. What
do you make of the behavior that we've seen in the markets across asset classes? Like you said, everything's pretty much up except for, I guess, the dollars, whatever. But
yeah.
Gold today, I think was up $163, 4,300,
4,400.
44. Wow. See, I didn't even check the latest.
Right.
And
last week, Jamie Dimon said that he could see gold going to 5,000 or 6,000. Did he realize that could be like 10 days later? Because we're less than a week after he said that, we're already at 4,400.
Wow.
Yeah. It is an interesting thing about what's going on with the markets. They're all going up right now. And it's a combination of animal spirits and I think passive investing. Animal spirits, everybody's bullish at this. Everybody's bullish about the prospects for financial markets. I was just at a wealth manager conference today, sponsored by Astoria Financial. There was a lot of speakers there. One speaker is Mike Green.
Yep.
I think you've had him on.
He's been on the show, talking about the passive bid.
Yeah. And he was talking about the passive bid. And we were talking about that. All these people were talking about the 60-40 portfolio. That's 60% stocks, 40% bonds. What do we do with the 60-40 portfolio? And other people said, well, maybe it should be 60-20-20. 60% stocks, 20% bonds, 20% something else like gold, Bitcoin, fill in the blank. Or maybe it should be 60-30-10 with the 10 being cash or something like that. And then Mike said something interesting. He goes, how come no one's ever thought about it being 40-60? That we should go 40% stock, 60% bonds? And the answer is because everybody's in a risk-taking mode. And when they talk about what are we going to do with the 60-40 portfolio, it's like we want to keep all our stocks and that 40% part of bonds? How do we put more risk in that? How do we buy juicier stuff there? We all want to take more risk. That's the animal spirits. The passive bid is we all, as Mike says, you hand the market money, the market buys. The act of buying bids up the market that excites the animal spirit to hand them more money, so the market buys, and the passive bid just keeps going and going, and it has the appearance of a perpetual motion machine, which is the way the markets have traded for the last couple of years. Whenever they sell off, it's been very short. COVID, after the Silicon Valley Bank failure, or earlier this year, after Liberation Day, very sharp down, rebounds very hard up on the other side. The passive bid is definitely there, and the buy to dip mentality is there. JP Morgan pointed out that in April, when the market sold off 15% after Liberation Day, it was professional investors that were selling. It was every retail investor buying as much and as hard as they could, and the market's up 40% since then. Last week, the market sold off on the story, 2 Fridays before we were recording, sold off on the story that Trump was going to impose tariffs on China, and the market sold off 2.7%. The next Monday, the market rebounded, and JP Morgan said the lights were dimming, that retail investors were plowing into the market so much. If you go on the Reddit boards, it's almost like it's like the world's upside down. They want bad news. They want terrible things to happen because that will scare somebody else to sell the market so I can buy the dip, because the market always comes back from the dip. Now, they're right. Yeah, they're right. It always does. But when you get that aggressive and that cavalier, you could get that it doesn't, period.
That's an interesting thought, though, like the retail buying and just the massive amount of retail buying. That's probably not necessarily like a bullish sign for the long term then.
It isn't, only because when you get that kind of aggressiveness in buying, and that you wind up getting mispricing in markets, that the markets don't discriminate between. The whole idea of markets and capitalism is to give money to good ideas, take money away from bad ideas. But when you're investing in index funds and broad-based funds and you're investing aggressively, everybody gets money. Even the bad ideas get money. Yeah. So you're not discriminating, and that can create dislocations and problems in markets. And I'll give you an example. Look at what's happening with AI right now. Michael Kembliss over at JP Morgan has put together a list of 41 AI and AI adjacent companies. AI adjacent would be like the power companies that supply the data centers and stuff. Those 41 companies of the S&P 500 are 47% of the market cap. They're half the market, basically. The other 459 companies in the S&P 500 are 53% of the market. Furthermore, if you go back to November of 2022, when ChatGPT came online, those 41 companies are 70% of the gain in the stock market. The other 459 companies are 30% of the gain in the stock market. Now, what's going on here? No one is discriminating. It's AI related. It's the 2 letters next to each other. Just buy anything associated with it. We saw this in the late 90s when some people slapped .com on the end of their company's name and the company would double overnight. The problem is AI going to be a big deal? Yeah, I think it is. I think it's going to be bigger than the internet. I think it's going to be one of the biggest things we've ever seen. But there's going to be losers in there, and not everybody can be a winner. And you get massive, what you would call malinvestment. A good example of that's data centers. People have pointed out the sheer amount of data centers that we're going to build and the power requirements that they need is not realistic. So how do all these deals get done? Because everybody's pricing every data center deal as if it's going to be a winner. We saw this in the late 90s. There was a company called Global Crossings. Global Crossings raised so much money to lay fiber optic cable around the earth so many times that when it blew up and went out of business in the early 2000s, there's more fiber optic cable than humanity will ever need that was laid by global crossings. There's dark fiber to this day that just means it's not turned on, that they laid 25 years ago because everybody thought every inch of cable was going to be a winning investment, and we so overbuilt it. And that's the risk you face, that you have these kind of dislocations. Yes, there's going to be winners and there's going to be losers. And as a matter of fact, in AI, if you look at people like Sam Altman at OpenAI, yep, he gave an interview recently, and he basically said AI is in a bubble, and it's going to be ugly. Not for me. My deal's going to work, but everybody else's deal's screwed. And you've heard other people, Jeff Bezos, David Solomon. They all kind of said the same thing. Like, yeah, AI is a bubble, and it's going to, a lot of these deals are going to go out of business. But all the deals that Goldman Sachs invested in, those will be the winners. And this is the other mentality that reminds me of the late 90s is, you guys are screwed, not me. My deal's the good deal. You all got the bad deals. And it doesn't quite work out that way.
Let me bring that back to an individual level. So okay, if I open my statements, I look at my 401k.
Wait, what's a statement? You look
I still get
phone.
the paper statements.
You look at your phone.
Oh, come on. No, I still get some paper statements.
Oh, you are really old school.
Oh, yeah, I'm old school or lazy. So you open up your statement. I just made one of them digital. So I'm like, oh, there's my gold.
What's the carbon footprint on your statement?
Who knows? They're probably losing money on me on stamps. Who knows? But okay, so let's say you look at your statements on your phone, wherever you look at them. Oh, my gold looks great right now. Yeah. Okay. Oh, my 401k, it looks great right now. Mm-hmm. Little stocks I'm playing around in, they look great right now. They're fun. Oh, my Bitcoin looks great, so is there a mentality where we all kind of feel like winners? It doesn't seem right. Like I shouldn't probably be feeling that way all the time.
Well,
looking at this stuff.
It's not that, some kind of Calvinistic idea that we need to have some kind of, pain and suffering to go with our life. The problem is if everybody wins, and everybody wins to this degree, it's nothing wrong with everybody winning to a certain degree. But if everybody wins to this degree, my statement looks great. Look at my gold is up 50%. My silver's up 70%. Bitcoin's doubled in the last 2 years. Stocks are roaring. Everything looks good. I want to buy a new car. So I don't want to deal with just pay the sticker price. Just pay up for everything. And then you get inflation.
Yeah.
So here's the problem.
You might feel more prosperous.
Right.
Than you really are.
So here's the issue I'll point out is that, and I'll quote David Kelly at JP Morgan, who was at the conference I spoke at today. 50% of all income in the United States is made by the top 10%, and 50% is made by the other 90%. So the top 10% are making all the income. And by the way, the savings rate for the top 10% is around 35% because, if you're making north of $250,000, way north of that, you don't spend that much money. Mm-hmm. You give it to a wealth manager who puts it in the markets, and the markets go up. As well. But the bottom 90% collectively, their savings rate is zero. Because the bottom 30%, they have a negative savings rate. They get government assistance to make up for the difference. And so if the top 10 or so percent are just making money, and to use the crypto argument, they're all out there buying neon colored Lambos and bragging about how much money they make and stuff like that. They're going to pay up for stuff and they're going to push prices higher. Now they can get by with it. I can get by with it if you're in the top 10% because you've got assets, you've got a home, you've got everything else that's going up in price. Bottom 90% loses because especially the bottom 50%, they don't have assets. They rent and they live paycheck to paycheck. So prices are going up because everything's being bid out of sight and they can't keep up. Their paycheck can't keep up with prices going up. They lose. That's why inflation is so important. Inflation destroys cultures. It destroys economies because it really separates you in an inequality way. The top half owns these assets that go up in price that helps them afford things that get ever more expensive. The bottom half doesn't. The bottom half resents that they can't keep up with the top half. They're not asking for neon Lambos. They're just asking for, can $100 today at the grocery store buy me the same thing for $103 in a year? Because in a year, my boss will give me a 3% raise. Can I buy exactly the same thing for $103? Hopefully the answer is yes. But if you have so many people with so much money, the answer will be no. They'll be bidding up. They'll be demanding so much stuff. They'll bid the prices up. And that could create a lot of distrust and a lot of uneasiness. And I'll give you one quick example.
Yeah, this is great.
Last year, during the election, the polls said, what is the number one economic issue? Inflation.
Yep.
The Biden then became Harris campaign correctly said, yeah, but it was 9% in 2022, and it's like around 3% now. So it's way down. It's under control. But you're missing the cumulative effect over all of those years, and it is such a psychological damage. I go to the store, I'm in the top 10%. I go to the store. I see the prices. I have a choice 4-letter word for the price.
Mm-hmm.
I just pay it, move on with my life. Somebody in the bottom 50%, they see the price, have that same 4-letter word, but here's the difference. To put that into my basket to buy it, I got to take something else out.
Yeah.
And that's what's happened in the last couple of years. And that's why inflation is so damaging. And to give you one last anecdote, a lot of the polls have asked people, would you trade a 1% lower unemployment rate for a 1% higher inflation rate? And the overwhelming majority of people say no. In other words, they view unemployment as somewhat, to use a Fed term, transitory. I lost my job, but there's another job out there maybe somewhere. I don't like it. It's terrible, but I can get another job. But when prices go up, they never, ever go back down again.
No.
That is a permanently high level that they're at. And then we have inflation on top of that, and they keep going up and they keep going up. So since prices never, ever correct, they would rather say, if you told me that 1% of the population needs to be unemployed to keep prices down, unemploy them. Don't let prices go up. That's how dangerous inflation is. And that's why, going back to what I said before, I chain myself and tell the Fed, you cannot raise or cannot cut rates, because you cannot make the inflation mistake. Because if you do, it's devastating. And I would be so, looking out for that mistake. And I'm afraid that they're discounting that mistake in terms of the unemployment mistake that they're worried about.
What do you think will be the longer term ramifications if they make that mistake with your thesis, like all roads lead to inflation? What are the bigger side effects? I imagine there's some serious ones as it relates to society too. Probably why we get certain types of candidates maybe. And
yes. You get candidates, you get protests, you get,
what about
you get a
fiscal picture.
Right. But you also, at the top end of the equation, you also get retarding markets. I mean, that markets aren't all as exuberant as they have been because of inflation. It can change things. Now, I want to emphasize, we don't have it now, but what I'm seeing from the Fed is, I'm not worried about that. I'm worried about unemployment. I want to try and goose, the financial channel to, get the people more employed. And I'm like, but we're at an all-time high in everything. What is it? Like I said, what problem are you trying to fix? And if the answer is you want more employment, then there's lots of ways you can fix the unemployment problem, but one of them is not cutting interest rates.
Yeah. On the inflation side, so all roads lead to inflation. Isn't there like some inflation's good, or like addressing the fiscal picture? Like we kind of need to inflate our way out of some of our debt.
It's an argument that's been made that, what happens is that if you issue $1 billion worth of bonds, what's the best way to pay them off? Well, if the inflation rate doubles and everything's worth $2 billion, you still have $1 billion worth of bonds. And it looks like half, relatively speaking, it's half of what it used to be relative to prices. Yeah, that's a way to fix the problem, is to inflate your way out of it. The problem is with inflating your way out of it is what we were just talking about. The damage you do to the bottom end of the bottom half of the economy, the damage you do is tremendous. It's funny because Jay Powell just 3 years ago in 2022 was aggressively raising rates. He raised rates from 0 to 4% 1 year, eventually went to 5% by 2023. And he used to give speeches, and I used to jokingly call his speeches, do your patriotic duty. Remember, 22, the stock market was corrected 25%. Bitcoin got under 15,000 or maybe down under 20,000. I know it went under 20,000.
Definitely crypto winter.
Yeah, exactly. And it was like, do your patriotic duty, you in the upper half, lose money. Lose money and be proud you're losing money because you're helping the bottom half by us hoping down inflation. You need to lose money because we don't need you to be making tons of money going out and buying neon Lambos and exasperating the situation. So lose money. That was his argument in 22. Now we've got the opposite argument. You're not making enough at all-time highs. We're going to try and goose things and keep going up. I understood the argument in 22. I mean, I didn't like it, but I understood it. I don't understand the argument in 23 because I don't think, like I said, I don't think the problems that he's trying to address can be fixed with interest rates. All he can do is just shove asset markets higher, and people are just going to make more money, spend it, and create more inflation. That's the risk I see.
Mm-hmm. I listened to a podcast with you recently. I cannot remember who hosted it, but I learned that you interviewed for a Fed.
Yes.
Was this was it a Fed governor role? Like what?
Yes, Fed governor. It's Fed governor.
That's pretty cool.
Yeah. So I'll tell you the whole story.
Yeah,
It was May of 2019. So Larry Kudlow is the National Economic Council chairman, NEC director, that Kevin Hassett has right now. And he had nominated, or Trump had floated the idea that he was going to nominate two guys, Steve Moore of the Club for Growth and Herman Cain, who ran for president and was the CEO of Godfather Pizza.
That's right. He had like a 999 plan.
Yeah, 9%.
Yeah, I can't remember.
Yeah, something like that. Yeah. So they were met with backlash. And then there was a day in late April of 2019 that they were both withdrawn. And I know Larry, and I got Larry's email. And I dashed off an email to Larry, and I said, hey, Larry, looks like you've got some openings for Fed governor. ... I'm available. And I said it half jokingly and half serious. And 10 minutes later, I get a response. When can you come to the White House?
Oh, my gosh.
So I went to the White House about 3 weeks later, and I met with him and Andrew Ullman, who was the assistant NEC director, who's now at Mayor Brown. And we talked for about 75 minutes. So two things that came out of that was just anecdotally. Larry was about 20 minutes late, so I'm sitting in the West Wing, his office on the third floor, on a couch. And every third person that walked by, everybody had a colored badge, but every third person that walked by was in complete Kevlar with an automatic weapon and hand grenades. And I was like, they were military. They were right. Yeah, and I was like, is this the most dangerous place in the world, the safest place in the world, the White House? And I decided it was both at the same time. And then finally I got in there, and Larry said he apologized because Trump was in his office until 2 minutes before I got in there. And that's why I was late. And he said, yeah, Trump comes in here like 100 times a day to ask where the stock market is. And Larry's like got his reading glasses on at the end of his nose. And I said, he tweets all the time. He could just look on his phone if he wants to see where the stock market is. And he looks at me like, that's not the way Trump works. He comes in here and he asks me 80 times a day where the stock market is. And he goes, so don't be surprised if Trump doesn't walk in here on us. Unfortunately, he didn't. I would have been thrilled beyond belief if Trump would have barged in and said, where's the stock market, Larry? But he didn't do that.
And that would have been your test, though, or something.
Yeah, exactly. So I interviewed with Larry, and we talked about the Fed. And my pitch to Larry was that the Fed needed more expertise on financial markets. And he actually took that to heart, because after he interviewed me, he interviewed a guy named Scott Minerd, who used to be the chief of, he passed away he passed away a couple of years ago, but he was the chief investment officer at Guggenheim for exactly the same reason. And he interviewed some other people, and they wound up picking Judy Shelton, who I supported.
Oh, yeah. She's been on this show before.
Yeah, I supported her immensely, and Chris Waller. And so Chris Waller got through Senate confirmation in December 2020, like 14 months later. Judy came up like one vote short. And
somebody was missing though, right?
Right. What happened was two things happened. First of all, Mitt Romney, Susan Collins came out. These are Republican senators from Utah, Mitt Romney, Susan Collins from Maine, came out against her nomination. And all the Democrats were going to vote no. So she couldn't lose another vote. It was going to be 50-50 with the Vice President Pence breaking the tie. But then Chuck Grassley, the Republican senator from Iowa, got COVID. And he couldn't he was not allowed on the floor to vote. They actually talked about putting him in a spacesuit and bringing him down there to cast the vote. So that's why she wound up coming up
They
one
couldn't even reschedule the vote?
No, because it was late December. And like a couple of days later, the new Senate was going to come in, and it was going to turn over to being a Democrat Senate because Biden had just won the election. So they were at the end of the line. They could have rescheduled it if they tried. You remember it took 14 months.
Oh my gosh,
So they waited way too long. So that's how she wound up coming up one vote short, unfortunately. But Waller made it through, and he's now one of the leading votes or leading people to become the Fed chairman right now.
Interesting. I haven't met anyone who's interviewed for the role before, so.
It was just,
But shoot your shot, right?
Yeah, exactly. He said, when can you come in? And Larry said I was a serious candidate. And I don't doubt it, but I used the analogy to my wife. It's like, the Olympic finals in 100 meters, there's 9 people. All right. I probably finished 8th or 9th, but I was in the Olympic finals.
That's still cool.
I was in the Olympic finals.
I've never been in the White House, so I can't say.
Exactly. I got a chance to go to the White House. I got to see Larry. I got to make my pitch. I'd like to believe I obviously had an impression on him because he brought in another market guy, Scott Minerd, to talk to him about potentially filling the job with a market person. So, but they didn't go in that direction, but they seriously thought about it. So I'd like to say that at least at the margin, I made a difference in that. But it was an experience that I would have liked. My wife, by the way, was super thrilled I didn't get the job. She just liked the idea of me becoming a bureaucrat, working for the Fed, moving to Washington, and stuff like that. She was like ready to vomit over the idea.
It's still a great experience. Okay, so speaking of the Fed, maybe some predictions. Who do you think is going to be next Fed chair? Like, how do you see the Fed kind of playing out until next May?
I was on a panel today at the Astoria conference with Neil Dutta, RenMax chief economist. And I'd been talking to Neil about this before. So let me give you an interesting idea and then a realistic idea. The interesting idea is, who does Trump want to be Fed chairman? Who has he repeatedly said, he's my first choice? Scott Bessent, the Treasury Secretary. And Scott Bessent, the Treasury Secretary, has said, no, I'm happy as being the Treasury Secretary. Now, the same names that we're talking about, whether it's Kevin Warsh, Kevin Hassett, Chris Waller, some of these are some of the names that we've been talking about these names forever and ever. Trump hasn't made a decision on any of these people. I think maybe the argument is he doesn't like any of them. He wants Bessent, and he's going to spend the next 2 months twisting Bessent's arm to reconsider and being the Fed chairman. Now, assuming that Bessent doesn't relent and take the Fed chairman job, and I know Trump said he'd be fine with him being both Treasury Secretary and Fed chairman at the same time, but realistically,
I don't think you can do that.
Yeah,
I don't know. Maybe there's a loophole. I have no idea.
Legally, you can do it. Legally, you can do it. Before in the 1930s and earlier, the Treasury Secretary used to be on the FOMC.
Interesting. Okay.
But then they had what's called the Fed Treasury Court in 1951 and split them up. Legally, you can do it. Or let me rephrase that. There's no legal reason to not allow you to do it. But they're both full-time jobs.
Yeah.
Trump thinks that the Fed chairman job is just, as he's joked, it's the easiest job in the world. You meet once a month and you make an incorrect call on interest rates. That's what he said as a Fed chairman. But the problem is they're banking regulators. And that 80% of the time that you do your job as a Fed official it's really about banking regulation. And to have the Treasury Secretary also being the primary banking regulator is a major, it might be legal. It's a major conflict of interest. So assuming that Bessent doesn't do that, who of the next list of people is most likely to be Fed chairman? I'd say Kevin Hassett, the NEC director. Why? Trump has made it very clear he wants interest rates down to 1%. And he wants somebody who's not going to Powell him. That's a new term, right? Powell him. Powell him is, you're going to tell me everything I want to go. I agree with you. I agree with you, Donald Trump. I'm going to do everything you say. Yes, yes, yes. And then the minute you get confirmed by the Senate, things have changed and we're going to go in a different direction. Hassett is probably the one guy that would not do that. You want the funds rate at 1%? I'll put the funds rate at 1% as Fed chairman. And that's why I think he's the leading choice. I think the best choice might be Waller. But I don't know if Trump can trust. Trump doesn't know Waller, but whether or not Trump could trust Waller to follow through on his dovishness that he's been, and I've even questioned some of his dovishness too. If you saying this because you're in the running for Fed chairman, or are you saying this because you actually believe it? Because the fear is once you become Fed chairman, you might go in a different direction. That's the fear that Trump would have. So I'd say it would be Hassett at this point, unless something changes. But last thought I would give you, something might change because Trump has had the same names for 4 or 5 months, and he hasn't made a decision on any of these people. Why not? And I still think it's because he's not enamored by any of them. And he's kind of saying to Bessent, why don't you take the job? And Bessent's saying, I don't want the job. Well, he's like, well, then give me a door number 2. Give me some other options here or something like that. So I wouldn't be surprised if even that happened.
Jim, I have to say, I always enjoy our conversations.
Yeah, I do too.
They're usually virtual, but this is great having you in person. I hope this isn't our last in person. Would love to get you back in when you're in the city. Before I let you go, will you let folks know where they can follow you, find your work, support your work, any of your research? I know you also manage ETFs. Not sure what you can say there.
Yeah.
Any parting thoughts for this audience? The floor is all yours. Anything you want to say?
So two ways you could do that. 2 things. One, you can follow me on social media at Bianco Research on Twitter X, at Bianco Research on YouTube, Jim Bianco on LinkedIn, and our website for our research business, biancoresearch.com. Second thing is we do manage an index. It is a total return fixed income index. So when I was talking about the 60-40 portfolio, we've been holding ourselves out as, what do you do with this 40 part? How do you buy the bond market? We have an index that we manage that tries to do that. And our partners at Wisdom Tree have an ETF, the Wisdom Tree Bianco Fund, WTBN is its ticker, that tracks our index. And so that's how we've set it up that way for various reasons, that I'm an index manager, not a portfolio manager. And then we have a ETF that just tracks our index. And I set the parameters on the index, and it's biancoadvisors.com is the website that explains everything about that. And so we've been doing that for about 2 years. Our performance has been pretty good. Been very happy with the way that it's been going so far. So if you're interested in a fixed income investment, that would be one way. Otherwise, if you're interested, you can follow me on social media, or you can look at our website at Bianco Research.
Jim Bianco, president of Bianco Research. So wonderful. Thank you so much for sharing all of your knowledge, your wisdom, helping us all learn and get better.